What's going on, Hot Take Nation? DRW here. Before we start this week's episode, I wanted to let you know it's being brought to you by a friend of the show, the Kuiper Law Firm, which is, not my word, but true, a multi-jurisdictional, full-service oil and gas law firm with offices in Houston, Denver, Dallas, Midland, Oklahoma City, and Lafayette. The firm is licensed to practice across most producing states, retains significant experience in every producing basin, and provides skillful representation across a wide variety of matters, including title examination, regulatory representation, acquisitions and divestitures, contract review, midstream dedication, and many other aspects of onshore natural gas and oil development. The Kuiper Law Firm strives to create an effective, efficient, personable representation by attorneys that understand and know the oil and gas industry. And every once in a while, they may take a LinkedIn banning case. Not always, but if they're a friend of the show, they'll definitely do it. Not only does their firm have extensive experience representing the industry operators and participants, but most of Kuiper's attorneys began their careers employed by operators. This hands-on experience allows the delivery of legal services that are truly effective and efficient for their oil and gas clients. Though the difficult market presented in the past few years has been tough, the Kuiper Law Firm remains committed to serving oil and gas clients. Alex Kuiper founded the Kuiper Law Firm with a vision of accessible expertise, efficient and quick service, and a client base revered as friends. I can attest to this. Recognizing the many hardships on industry professionals today, the firm actively participates in free educational events available to all, welcomes questions from industry professionals that they address in their blog, and is available to all clients and non for guidance in these challenging times. So, thanks to the Kuiper Law Firm for sponsoring this week's episode, and on with the show.
What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. And today, as we've been working on our theme of people who disagree with me, of which there are many, Dan Pickering is joining the show, and he is going to be making the bull case for why energy is about to relive its greatest time in history. Dan, welcome to the show. How are you, man?
Hi, David. Good to be here.
I've obviously followed you for a long time. You're very well known in energy circles, and let's start with, why is energy ripping the way that it has post-vaccine announcement on, I guess, November 9th?
Sure. And it's post-vaccine, post-election. Both of those things, I think, matter, and we're ripping because you have the combination of a group that's massively sold off. So worst performing group in the S&P, 10 years, 5 years, 3 years, 1 year. And so it's been a terrible group. It sits squarely in that value category. I think post-vaccine, post-election, you have this value rotation that's happening where you're selling momentum and buying value, and a vaccine's good for demand and people are getting some hope. I think it's hope in the middle of 21, 22 time period, but when, stocks are down 75%, it's easy for them to bounce 25%, and that's what we've done.
Now, when you think about the hope, I always say hope is not a plan. And, it's interesting, feeding into 2020, there were cracks in the economy. Now, the president would not have liked anyone to have said there were cracks in the economy, but we were at all-time highs in January, February overall for the market. And we've done nothing constructive other than pump stimulus into the economy. And yet we're now at new all-time highs. And we're having investment banks coming out saying, S&P 4,000, S&P 4,600, US dollar down by 20%. And so in the main market, valuation has really been absolutely irrelevant. I think we look at Tesla up another 6% today to 530 a share. How do you think about value in the context of the backdrop of these valuations that make no sense?
Mm-hmm. The value conversation has has been one that's fallen on deaf ears. And when valuation doesn't matter, folks are so hungry for growth because it's sort of hard to come by in this environment. So I tend to think that you got to wait your chance at the kind of the casino here. And I am nervous about how much we've run in the face of not a lot of fundamental improvement yet. And David, stimulus is all that matters. And for the last couple of years, cheap money has been the only story that's mattered. And so the market's going to ride this thing until it gets bucked. And I don't know when that's going to happen. Quick anecdote. I remember when I started at Fidelity, that was in 1994, call it. And we saw this chart of household debt, and household debt was going up. And it's like, that's going to kill the market. Well, that killed the market in 2008. It took 14 years for that issue to matter. I don't know how long it's going to take for valuation to matter. And so that's why I think it's much easier to run small money than big money right now, because you can just wait till something rolls and then get out. And that way you don't miss the next 50 that's on craziness.
So let's think about oil and gas specifically. And I very clearly remember the June timeframe where there was about a 2-week period at the beginning of June when energy stocks were ripping, and they were much, much higher. The small caps, big caps, everything was much higher than where we were today. And all of a sudden it just turned, and that was sort of like this mini bull market in the sea of red.
Uh-huh.
How do you differentiate what happened that June and where we sit today? Again, there's a vaccine that's coming, but what happens to these work from home stocks, which everyone says now we're all work from home, we don't need to commute. Emerging markets, regardless of cheap money, are relatively low. 7.7 million barrels a day of OPEC crude is on the sidelines. How do you differentiate the backdrop of June versus the backdrop of today?
Well, we have more visibility now that we're going to have a vaccine and something can get better. So we've got more visibility there. That's about it. OPEC's got, you mentioned the scary things, and the other visibility we've got is we have a split House and Senate, so we don't have a blue wave. I'm from the government, I'm here to help. Probably is not going to be as bad as we expected. So from an energy perspective, political situation, rough but not disastrous. Vaccine situation looks better. But I keep coming back to, it's this rotation element that now we know we'll have fiscal stimulus. Nobody wants to think about when we're going to pay that bill. So you put those things together and that's the move. It's a better move than it was in June. I don't know if it's the best move or the volatility's not gone. Is it the turn? We're in the bottoming. We're going to turn at some point. We've probably seen the lows. Could we give up 15 or 20%, having gained, 25 to 50%? Absolutely. We're probably not done zigzagging here.
So how do you value oil and gas companies? Because, there's a lot of different ways, and over the past year and a half, I had been an advocate for simple investors. And again, this show is not about investing. This is about the major issues of oil and gas. But I always found it very valuable that each company once a year would have to report their SEC at a flat price deck. They would run their PDP. They would run their 5-year reserve model. Now, a lot of people who pushed back on that said it's because they didn't believe the reserve auditors. But at least on a relative value, they would say, well, here's what I think I'm going to do for the next 5 years, discounted at 10% at this price deck, and I'm going to run it. Now, that intrinsic value is very different than a price to cash flow where, historically, as you've looked at relative valuations, well, they're a Permian play, so they deserve 7 times price to cash flow. They're a Bakken, they should be 4, but it doesn't tie to an underlying value. How do you think about value in your career and when you're thinking about things you like and want to buy?
Yeah. So first of all, I think you've got to assess what is the market paying for? And that is the most important metric of the day. And right now, that metric is some combination of free cash flow yield, potential free cash flow yield at a future oil price that's better than down here. It's some price to cash flow metric, and a very distant sort of metric right now, but I actually think is important, is NAV. But it's got to be an NAV from my perspective. The transformation of this business, you look back 15 years ago, you didn't do NAVs because you guys had 5 years worth of inventory, and a cash flow multiple and NAV were kind of the same work. Today, an NAV is a much different set of analyses than a price to cash flow multiple. And so I think that NAV tells you where you could go, and it's, in my mind, much easier to sensitize commodity price forecasts with an NAV than it, are people going to pay 3 times cash flow if oil's 70 or 5 times cash flow? We're guessing, right? And it's much easier to say, I think if oil trades at X, this is what the assets are worth. Tons of assumptions in those. So I think price to cash flow, free cash yield, potential free cash yield are the metrics right now, and NAV is your backstop. And you've got to make an assumption on what you think the realistic long-term price accrued is. And I don't think that's the strip today, but you've got to be realistic about what those numbers are going to be.
So let's talk about, because again, the strip everyone talks about, the strip it doesn't predict the future particularly well.
Right.
But it also doesn't appear to be baking in the current valuations very well. So on the one hand, valuations of companies are discounting a certain price. And right now, I would say they're discounting a 50 to 55 price, whereas traders are thinking about the world in a 41, 42 world. I'm curious how when you think about price decks, what do you think both the market should be running right now for the next, let's say, 5 years, and B, how do you correlate that with US dollar devaluation, demand, supply, this massively negative, the Green New Deal, and we'll talk about ESG in a second, but how do you integrate all of that knowledge and thought?
Yeah, so I think if we believe the world's got to keep producing 100 million barrels a day, give or take, and we'll talk about, sounds like ESG and transition and all that sort of stuff in a bit, but you got to maintain 100 million barrels a day. $40 oil is not going to do it. U.S. production's falling. Global reinvestment has been hampered. Production's going to come down if oil's 40. And so if production needs to stay flat, we got to have a price that's going to encourage that on the supply side. So I kind of think about somewhere between low 50s and mid 60s is a number that production can be stable and probably grow. And we've seen that historically. You're trying to balance that with the fact that we're probably running out of our best core inventory in shale in the US. And there's a lot of oil out there. We're not running out of oil anytime soon. So it's just a function of how much we spend to get it out of the ground. So I tend to think, I feel very comfortable running 55. When I think about what my longer term price deck is, it's 55 with 65 as another number, and stocks have discounted lots higher than that in the past. Is that the 5-year actual price? Probably not. I mean, what we care about as public market investors is what will the market pay for? It's going to be something in the 50s and might be something in the 60s. Not soon. We have to see that tightness, but when we do, I think for round numbers, let's call it, we'll discount 60 long term. It's different in the private markets. In the private markets, I think you use the strip, and if you're bullish, you add a tiny bit on top. But the world uses the strip. That's where you can hedge. It is the price from a hedging perspective. And so I can lock things in, and I think there's a ton of optionality around $40 oil. But do I need to pay for it right now in the private side? Probably don't.
So you touched on the difference. So I think about private, and obviously there's a lot of private equity firms that were positioned for a position, and we've seen not what we expected. And in fairness, I know that there have been, you and I are both on Twitter, I know that there have been people who were short shale and the business model for a long time, and coronavirus was the catalyst that led to like an 80% destruction in small caps, like over a very short period of time. But in private equity, where the capital is more patient and it's taken a huge amount of time to invest, they're now long assets at a time when they're probably fundamentally underwater. How do private transactions and how does private capital start to come back in the market constructively? And how do they buy assets that are worth buying given the bid-ask spread that exists because of exactly what you talked about? What price are you discounting? And if you're a buyer, you don't really want to go much more aggressive than the strip. But if you're a seller, you sort of have this intrinsic view, the world's getting back to 55. Ergo, there's a big bid-ask spread. How do you think that works in the private market over the next year?
Yeah. So I think over the next year, private equity, most guys are very focused on their existing portfolio, and I'm not sure they're playing a ton of offense. Trying, but, and the guys with the hard part is most of the guys who have money are big. They've got billions, and it's hard to find someplace you want to spend 250 to 500 million. The opportunity set where you can find these assets, I think at decent prices, sits down in the, in the small lower end of the market, 25 to $125 million deals. So I think PE is trying to fix its own portfolio problems, salvage the investments they've got, look for new things. Big stuff is just going to, I don't think there are tons of discounts in big stuff. And so the private market, in a way, we've got a fund that looks at PDPs in the Permian, and anybody that tells you they're buying PV20 on PDPs in the Permian isn't, right? That's a lie, right? Good assets in good basins are trading at somewhere between PV10 and 15. And the question is, how bad do you want them? How much do you want to pay for an option? The oil price optionality, I think, is real and valuable. And the guys who don't have to sell aren't going to sell for a while. So it's the distress, and the stress process is painful and it takes a while. So I think 21 is the year where folks who finally have to give up some assets are going to. Yeah. And you're going to pay $40, $45 kind of oil prices to get there. And probably you should. We want to get money involved here in the next 18 months because I do think there's a cyclical recovery. And whether it's from the private perspective, if it's the first 3 months or the last 3 months of that, probably isn't that critical. It's getting the capital deployed. Yeah, for sure. Now, one of the big topics in the last 18 months, which has been a drag on our industry, has been the ESG conversation. Now, I've made the point that I think that our E is pretty good, our S is pretty good, and our G is atrocious. And if anything, we've doubled down, and I won't make you call given your role. I won't make you actually address this comment. But the G hasn't got better, in my opinion. We've put some sustainability scorecards out, and people have talked about stuff. But like at the core, nothing's changed. And yet, since the election, stocks have ripped 25 to 50%, which sort of makes the point to me, no one cares about ESG. They care about when they can make money. And that those investing in New York are going to follow the money flow. And you can have the greatest ESG report in the world, and that's not going to bring investors back until there's a macro call that says valuations are cheap, oil's going up, cyclical recovery, rotate out of growth to value, and buy. I'm curious, in the broad sense, how you integrate that with this. We have diversity on our board, and we have this great environmental report that we've hired consultants to do, and we're just knocking it out of the park on ESG. That's why investors are coming back. I'm going to both agree and disagree with you at the same time. And let me
Great.
I think that of the people that have left investing in energy, 25% of them are gone for good because they think hydrocarbons are bad and it doesn't matter what the industry does on the ESG front. They're just gone. 75% of the people that have stopped investing in energy will come back if they can make money. And they haven't proven that yet. And I would say this bounce is not really driven by the big money players that are concerned about things like ESG. It's driven by, it's not huge volumes. And, okay, so we bounced from 2% of the S&P to 2.3% of the S&P. We're going back to 7 or 8 at some point. So I agree, the money and the performance will pull people back. But on the margin, what are they going to do? The big money will get sucked back in, but they're going to pay attention to who's doing, quote unquote, the right stuff. Here's where I disagree with you. I actually think in the mind of the market, the E, the S, and the G, none of them are good enough for ESG folks. The E side, we're hydrocarbon, and the industry is going to have to improve. The S side, it's not a particularly diverse workforce, and to the industry's credit, it knows that. It's got the same challenge every industry has, which it needs to be more inclusive. And on the G side, it's also not good enough. And I think that we're seeing kind of the last leg of the governance fight. You look at guys like Evercore, which have been pounding on corporate governance and alignment. The Kimmeridge folks came out and started talking about executive pay versus performance. I mean, this is what happens in the final stages of a down cycle, which is, why am I paying you millions of dollars to lose me 75% of my money? And so you're attacking cost wherever you can, and executive cost is also, getting attacked there as well. So I think the industry is going to have to do better on all the ESG things. Investors will come back, but if you want to get more of them, you'd better be better on ESG.
Right. Now, we've seen a relatively big change in terms of the views towards M&A. And all the way through 2019, I was advocating, it's looking constructive. The U.S. can't grow because we've lost tier 1 inventory. We're drilling too tight. Declines are too steep. And there's a restraining of cash flow and debt and access to capital. So we're going to decline. That's constructive for prices. Share prices were substantially higher when we saw the Oxy, Chevron, Anadarko event. Everyone seems to forget that when that deal was announced, oil was 73. Now it went in a straight line down to negative 37, but it was 73. We've seen some M&A here in late Q3, early Q4. I'm curious your views of the continued pace of M&A. Are we going to have a little slowing? Have there been some companies sitting out that you've been surprised by so far? What do you think about the M&A world?
Yeah, surprised me. It surprised me that we've had this much this fast, and I say that because we've had several pretty big deals here in the short term. And David, I've really been struggling with exactly what's going on. Concho is the one that's most interesting to me. If you look at Devon WPX, Rick runs that company. You've got, so I can see that one happening. Pioneer and Parsley. I follow that Permian consolidation. Brian's, in Austin, ready to, I guess, do less. And so, but why was Concho a seller here? That was the really interesting one to me. There's either a view that this downturn lasts longer, or it's just too dang hard. There's not a lot left to do. Tim on the call said 40% decline rate's pretty tough to slot into a market that wants free cash flow. So we need cost out of the system. And the beauty of this consolidation is folks are saying, I don't know when it gets better, so I can't wait. I got to take action now. Who's left to be a buyer? The European majors are not going to do it. They're doing wind and all that other sort of stuff. And so the European majors aren't buyers. Exxon seems to be under pressure, and they got a big dividend yield, and do they issue shares and have to pay you out even more cash? But you'd think that the logical next steps would be continued consolidation by the guys that are doing it now. So Conoco and Devon seem to me like they could continue to be buyers. Maybe Exxon shows up. Private equity's got some money. They could be a consolidator, take privates and things like that. And then the real question, and I'm afraid there's no good answer, is on the smaller medium cap, the guys that are over levered. Do we see these sort of marriage of the misfits that, and I use the word misfits, the market views them as misfits, and they're obviously companies that have too much leverage, and in many cases that's the biggest problem. So I think the biggest question, are we going to see small guys get together?
Well, how do you,
fewer buyers than before?
How do you reconcile that? Because again, one of the very interesting things is 2 weeks ago, going into the election, the last week of October, investors had sort of thrown their hands up, being like, oil demand is going nowhere. The lockdowns are happening. This is atrocious. In a $35 world, quite frankly, these small caps in a $45 or $50 world, many of them probably go to zero. And you and I know that you got in a bet in sort of the February, March timeframe with some people on Twitter that we'll talk about. And I'd been long the short, the small caps, going into coronavirus. But when oil was no longer looking to be 60 for a sustainable period of time, and oil was 40 for a sustainable period of time, you look at their ability to drill, access to capital, exist as an entity, and I was like, well, that doesn't make sense. And so what's again unique now and in June was these small caps were rallying because they're so torqued to oil price. But if oil price falters, they reverse the move 100% entirely, because many of them are struggling with debt covenants when you come to the spring redetermination. Again, how do you integrate this as an investor? And do you just avoid the small caps? Are you just, casino gambling when you go buy a CDEV, which is up, 50% in the last 5 trading days? What's your take on that?
Yeah, first of all, investor, know thyself. How much risk are you willing to take? And then you've got to do the work on the companies, because there are some, how optimistic are you on price? How long a runway does a company have? And you put those two things together, and that should create a hierarchy for you. And then you say, how much risk do I want to take? In my public portfolio, I've got a bit of a barbell strategy on, with a few what I would call names that the market misunderstands and expects to go broke that I don't. I think they could be 3 to 8 baggers. They're small cap, sub 500 million market caps. I wouldn't have a portfolio full of those. I wouldn't advocate that anybody actually owns some of those names if they're looking for dividends or looking for safety. And so how risk seeking or risk averse are you? And the flip side is you can make, 50 to 150% in larger cap. Conoco is probably a double. Do you need a 4-bagger if you can get a double out of a company like Conoco? I don't own Conoco in my portfolio, but I'm about to, because I own Concho. That to me is, what's your risk tolerance? And for the most part, generally, folks ought to stay away from something trading under $1, you are in the casino, and it's either a casino on that specific name or on the commodity, one of those two. And if you've got conviction about either the name or the oil price, then you can play. But you probably, if you're going to have conviction on one, it better be the oil price, because a bunch of these companies, like you said, they can be great companies with great assets. Their balance sheets are too stretched. They're not going to make it if the commodity doesn't cooperate.
So how convicted are you at this point in the commodity? And because that's the $1 million question, right? That's the $100 million question. Is, I agree with you with 100% concurrence. Oil price will be higher because the world can't manage to grow oil in a lower price environment. I would say that, for example, Saudi Arabia, when they came out and did their IPO in December of 2019, they announced a 53-year proved reserve life index. Again, we can debate the merits of what proved is and reserve auditors, but 53 puts it approximately triple Exxon. At the same time, Europe is saying no fossil fuels. We have a climate change emergency. And the U.S. has now really moved, especially with a Democratic government. Even if we keep the Senate as Republicans, you're going to see a big push towards more renewables, wind and solar, and that will have to play out. If you're Saudi Arabia, if you're the UAE, if you're Iran, if you're Iraq, if you're Libya, you're sitting on this oil that you're being told is going to be worth nothing in 50 years. Does that not accelerate investment into those countries where they have lower cost resource and displace American barrels that need a $60 world? Then again, that doesn't help U.S. companies because Exxon's not going to go do a massive development deal in Saudi Arabia. But I'm curious how you balance, like, what is the commodity price, and then what role do American oil companies play in a global commodity that is arguably on the decline, although I disagree, globally?
There's a lot to unpack there. You'd better be on the lower end of the cost curve in general in a commodity business. And the U.S. probably has some, we produce 10 or 11 million barrels a day now, and half that's probably on the lower end of the cost curve. The other half isn't reinvesting right now. You're right. We just saw Abu Dhabi talking about spending $125 billion to accelerate or increase their productive capacity from 3 to 5 million barrels a day. Why do you do that? Because you're worried your inventory could go away. So 50 years is a long time, though. This is the really hard part, I think, is that right now the market expectation is that beyond 10 years, energy reserves are worthless. Reality is they're worth something a lot longer than that. That inherently says the market's probably mispricing oil assets because it's sexier to talk about windmills, and you're seeing a lot of headlines. I mean, the debate would be in 25 years, how many barrels of oil are we consuming annually? What's the over under? Is it 50 million? Is it 75 million? I don't know, but it's not 0 and it's not 10. It's a big number. So the U.S. has always been, because of our system, right? We got the best system in the world. You can get access to resources and capital and drill it and go crazy. And so we've always been a little bit on the margin with a lot of our activity. And I think we'll stay on the margin. We disrupted the global oil business from 2008 to 2015. Can we keep doing that? I'm not sure we can keep doing that. The guys who have the really cheap oil are the sort of big dogs, and OPEC and Russia showed us that in February. They crushed us, and they could crush us again if they wanted to. And so I think inherently the U.S. is going to be at the mercy of price signals. That cheap international oil is going to fight us until we're all retired. But we're still going to need some combination. We're not going away because we got it. We'll come in, we'll come out. International is going to be the guys that are just kind of pounding at it for the next 50 plus years.
So does that make you think that some of the super major U.S. companies who, Exxon, the storied brand, been around forever, was once the world's largest company, you could, certainly public,
yeah.
And, Zoom got bigger than it for a period of time. Lots of pressure on the balance sheet. And again, this is the dislocation that I struggle with. Exxon in the first half of this year did $6.3 billion of operating cash flow, $11.5 billion of capex towards reinvestment, and paid out $7.5 billion of dividends. And they plugged that roughly $12 to $15 billion hole by putting debt on the balance sheet. Oil prices are not higher today. Their capital investment plan is not materially lower than that. Their dividends haven't been changed and they haven't cut. So we continue to see the building of debt to backstop equity payouts. And it's not the only company in this space that does that in a $40 to $45 world. And we're at the mercy of Saudi, where Russia, they could increase production, take the surplus of the 7.7 million barrels a day and drive oil to $30. Are you surprised that Exxon hasn't changed its dividend strategy? And again, how do you balance the fact that they're pouring cash out every quarter with we're through the bottom and this is the turn, other than an explicit bet solely on oil price?
Yeah. I'll start with, I think Exxon's wrong-footed here in the terms of the market, in that they are going the wrong direction, right? They're free cash negative and the market wants free cash positive. And because they haven't cut their dividend, ironically, they're just as big a play on oil price in terms of the stock as a lot of these, mid-cap E&Ps, because $5 a barrel makes a big difference in terms of closing that gap with the dividend and free cash. So why are they wrong-footed? They're wrong-footed because their assets, all these super majors have these legacy assets that lasted for a long time, and some of them are in decline, and Exxon hasn't offset that as well as some of the other guys have done. And so they kind of have to be reinvesting here. I don't think they want to. And the dividend, I think they've got their backup about the dividend and don't want to be the guys who I'm not that close to Exxon, but I can tell you they don't love all the stories about how they used to be great and aren't anymore. And cutting the dividend is just something I think that is going to be too much of a bitter pill to swallow, unless this commodity duration lasts another 2 or 3 or 4 years. They don't hedge. So I think Exxon's being stubborn. They're trying to get their asset mix in better shape. They're telling you they're an oil and gas company for the duration. I respect that, because I think the guys making the pivot are probably reinvesting at very low rates of return. So they're taking a longer term approach, which feels pretty bad in the short term. And that's the one advantage you've got if you're a really big company, is you can think longer term. And I think they're doing it from an asset base that's not as strong as it probably needs to be.
Let's talk natural gas for a little bit, because oil obviously dominates because it's a global commodity, and historically for the last 6 years anyway, natural gas has been kind of a waste product. Somehow we've made a business work at $2.50 an MCF, whereas I remember very definitively in 2012 through 2014, you'd be like, well, anything below $4 an MCF, this is not even, like, we can't sustain low prices. We have sort of a similar view on oil, ironically, in that we can't sustain low prices, and yet, gas prices have been low for a very, very long time. What do you think about natural gas in the United States, the role it's going to play, some of these Appalachian players, Haynesville players, and as the sex appeal goes from oil to natural gas, where do you sit?
Yeah, so let's take that last point first. Interesting to see companies now talking about their gas exposure, because gas prices aren't $2.25, they're now $3. So the natural progression of talk about what's working is happening in the stock market and the public companies. But we got a lot of natural gas. We've gotten really good at drilling big wells pretty cheaply. Service costs are unsustainably low, but supply demand, right, folks? Rig count cratered. And so supply has come off. We've got more exports with LNG, and that's back now that COVID has sort of eased a bit. And so we've got an export market with LNG. We've got a cleaner fuel generally, and supply is down, and supply is kind of constrained out of Appalachia. And so you look at that and think that commodity, gas could have a decent run here for 18 months. We got a lot of it. Price is better. It'll get drilled. I don't think you look at $6 gas or $5 gas or $4 gas, or you hedge the hell out of any of those that happen. It's it's the natural bridge fuel toward more renewables. It's the backup fuel for renewables. It's the interim fuel while we get storage figured out for renewables. And the green guys still hate it because it's a hydrocarbon. The industry's got a problem perception-wise and reality-wise around flaring and greenhouse gas stuff, and it's got to get better. That goes back to my comment of it's not good enough, it's going to have to get better. And guys have found a way to make money with it, and associated gas has come off given oil production's come off. So I don't hate gas. I don't love it. I think it's a probably fairly valued to maybe a little bit cheap in the near term commodity. Supply, I think, is going to rise to meet price, but that will take a little bit. And so I still think oil's more dislocated and probably more interesting, but gas is going to have it stay in the sun here for the next year.
I agree. And so do you think that you see some of these very oily names? Now, obviously, we saw EOG come out with the worst kept secret ever. They have a South Texas gas field they've been drilling for a long time. Everyone knows where it is. Everyone knows what they're doing. And they recently added it to their premium inventory because they want natural gas. But you do see a lot of players in the Appalachians that on some metrics look cheap if you believe you can handle the firm transport and some of the debt obligations. There's some companies that look cheap. Do you see some historically oil companies that haven't participated in the Marcellus and Appalachia aggressively start to move over there? Or do you see more of a consolidation like EQT buying CVX's asset out of there? Not the CNX, which was a false rumor, the CVX. What do you think happens? Do oil guys throw in the towel on oil and say, hey, we need to be natural gas, and we recognize that now?
That would be the oily guys buying gassy guys would be sort of the full cycle, what's old is new again kind of thing, because everybody was selling gas and buying oil or selling everything to be a concentrated basin player. And, that would be the expansion out of, one basin into others. So that would be the natural culmination in this cycle. That's also, it's tough though. It's tough because what's that, if I'm Cabot, what is a buyer better pay me a premium because I'm the one helping them. I'm getting them the gas exposure. I've got the good balance sheet. They probably don't have as good a balance sheet as me. Oil isn't as great. I think that would make some sense. Take that free cash off your gas assets and invest in oily assets that need development. It makes sense. It feels hard to do. If you do one, you'll probably do four. The herd mentality sort of feels like if it got some traction, it'd get some traction.
I agree. If you were to give one surprising merger and that you think that has a high probability that would happen, are you willing to throw a name out? And it could be oil to gas, it could be gas to gas, it could be gas to oil, it could be any combo. Is there a combo that you think would really turn the taps on, or have we seen that? Did we see that with Chevron Noble and Devon WPX and Conoco Concho? A lot of those guys, I'm not at all surprised, participated. So are there people that you would say, wow, that deal totally logical, makes total sense, zero premium, but long term is probably really good?
Yeah. One that I actually think could happen or will happen.
Yeah.
I hate it when people don't answer questions. I don't have a good surprise merger. I could tell you here's what would surprise me. This is not a prediction. This would surprise me. One of the majors buying EOG would surprise me and make a ton of sense. What else would surprise me? Anybody doing anything with Oxy would surprise me given their balance sheet. I'll stop there. This is a world where surprising stuff, the Conoco Concho makes a ton of sense. I was surprised Concho was a seller. Then you dig through and it's like, okay, not crazy. Concho to Shell would surprise me because I'm not going to get as much upside in Shell stock, but I do in Concho stock or in Conoco stock. So I'll just stop with the ones that might be surprising, but I'm not predicting.
Well, I mean, I think that the interesting thing about the Conoco Concho is, and again, I lived through this in 2006 when Anadarko bought Kerr-McGee, except that really what happened was Kerr-McGee bought Anadarko. And all the management positions, like 80% went to Kerr-McGee people. Kerr-McGee people's options cashed out at 40%. They got new options, and the Kerr-McGee culture carried on. And so it's interesting from a cultural standpoint. Conoco definitively put the three senior leaders of Conoco, Will Giroux, Jack Harper, and Tim Leach, will be continuing on with Conoco. They will be continuing to have a big Midland presence, and that's not surprising because Midland is the center of the Permian, and the Permian is the center of oil. And so it will be interesting to see culturally, you're going to have a whole bunch of Conoco people that ultimately will be displaced, because you're going to have Concho taking a larger role. So that is one way they've addressed it. I won't make you comment on that because, again, I know that you do this for a living. But then the other one that I would comment on for sure is Exxon at EOG. I think Exxon should buy EOG. I think EOG is definitively short of resource, but they have shown that they have the best way to run an asset in the United States. They find the assets. Oh, go ahead.
You said EOG is short of assets, or did you mean Exxon is short of assets?
I think EOG is short of inventory.
Okay.
And the reason I say that is I think their Eagle Ford asset is very, 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 very drilled up. I think their Bakken asset is very, very, very drilled up, which leaves just the Delaware, and some of it is exposed to Fed. And I'm not saying that we're going to see a Fed versus not, but New Mexico is definitively a phenomenal part of the basin. And then Wyoming is the nut that continues to be, in 5 years, will crack the nut. And so because of that, I think EOG is short dated inventory. I think that Exxon is long inventory that EOG could get their hands on and run it better. And so I would love to see Exxon buy EOG and then to execute a similar to XTO, but turn all of Exxon's onshore U.S. assets over to EOG to run. I think that would be a very, very positive move, and the market should love it because it would be able to unlock Exxon's assets.
If you're an EOG shareholder,
You would hate it.
I think you'd better get a premium, and I don't see a premium big enough that satisfies me as an EOG shareholder. But stranger things have happened. There's a message there as well. If that deal were to happen, there'd be a message from EOG, from both companies, about what the heck's going on. And I would question the ability of the EOG culture to survive within an Exxon acquisition, which would be one of the reasons you'd want to do it if you're Exxon.
I would agree. So 2 more questions for you. One more, a question about you, the man. Talk about your career for those who are listening, because you've lived through so many parts of the cycle, and this appears to be a permanent change. It's not just low prices solve low prices, they'll go higher and we'll get back into this window. We've sort of played out the shale. We've played the acquire and flip. We've played the euphoria. We've played the balance sheet access to capital. And now we're in a different mode, both good and bad. I'm curious how you think about the ebbs and flows of your career and how you've been able to manage expectations. I thought I'd be able to do this. I started Pickering Energy Partners at this time because of this, and then this happened. How do you keep focus and keep passion and keep energy and keep optimism in the context of everything you've seen over the length of your stellar career?
Yeah, well, that's very nice of you to say. So I think underneath it is do the stuff that you like to do. That I have always been really intrigued by the stock market, and I, from a very young age, was involved in the energy market. Young age meaning my undergrads in petroleum engineering, and it's an industry that truly does change the way the world operates. 100 million barrels a day. People drive everywhere. It's critical. And folks that don't believe that, try going without your lights in your car and plastics and all that sort of stuff. So I like the industry and I love the market and I love making money. And you put all those three things together. And so I didn't love being an engineer, so I stopped doing that. And I went back to business school and I found out that I could go be a stock market guy. And I did that in Boston for a while, and I found out I didn't like Boston. And so I came to Houston, and I liked working at a small company. I came and worked at Simmons and Company, which is now Piper Jaffray, when it was 25 or 30 people, and that was fun. And I like figuring things out. That's the analyst in me. I like being right. And so you can be right and bearish and right and bullish. And so being right is sort of critical to being successful in the markets. And so trying to figure out how to be right is important. And I like to communicate. And so whether it was doing sell side stuff at Simmons and then again at Pickering Energy when we started, or writing these monthly letters that I do, or talking on Twitter, I like that interaction. So, and that's helped me stay, relevant and involved in the business. And so the message is you stay optimistic by doing the things that you like. And I'm fortunate from the perspective that there's a lot of volatility in what we're doing, both the market and oil and gas. And so, it's changing and you learn all the time and work with good people, interact with good people. And so, and the other piece of that is it's been a long time now, almost 30 years, a little more than 30 years. It's crazy how many people you run into that you worked with 10 years ago or 15 years ago, or you talked to and haven't talked to in 8 years, but there's something relevant to discuss. So, there's no secret other than hard work and doing what you like, and finding something hopefully that you're reasonably good at least 55% of the time. And if you do all those things, you ought to be happy. And this is a business that rewards being right, and so that makes it a good career. So that's all qualitative, but
I like it. I like it. I think that gives, for those who are in a profession or still trying to get back into the industry, what can they do? Well, do what you love and then have a thesis that you can make money on, because this industry rewards correctness. And if you're correct, you'll be successful.
Yeah. One other thing I think worth mentioning here is that it is not as easy a time right now to be a young person in the conventional oil and gas business, because I'm sitting here, I'm 54 years old, and there's 20 years left for me in this business. I don't know if there's 50 years left for the 25-year-old guy. And so that's, now's the time period to really be thinking about what do you like and what sort of skill sets are going to be applicable over a long period of time, and getting those in your career. And you can learn so much in the oil and gas business. The other piece is you'd better be working for a company you think is going to make the right moves. Working for a mediocre company in the next 20 years in the oil and gas business is not going to be any fun. You better find a good one and learn as much as you can from it, because the world is going to change in the course of a 25 or 30-year-old person's career.
Well, and that's certainly the advice I give, is that you had to realize that in 2000, you could argue going back to 17, 18, but certainly by the end of 18, we had moved out of an acquire and exploit, or a drill and flip, or call it what you will, and now we're definitively in a drill your returns. So those who look back to the heyday of private equity and say, man, I wish I could leave this stodgy medium company and go make a whole bunch of money like those guys that did that model, I warn people, especially young people, it's not the same, and that you're best to do the best job you can at a large company that will survive, because the likelihood of a mediocre company surviving the next 20 years and then there being enough employment opportunities for you to get back in, given that now every drilling engineer job that is posted, you probably have 1,000 applications because we've already lost so much jobs and will continue to lose those. So I say, if you're in a good position, work your ass off, do the best you can for your boss, and survive to kick the can down the road long enough. So last question, and it revolves around Twitter. I saw that you did a video challenge where there were some interesting entries and some very entertaining entries. Talk to me about that, but then also broadly the value you get out of Twitter and what you think of that community. And again, it's a very interesting community for those who are not on Twitter. Talk to us about the Twitter community.
Yeah. So first of all, what is it? And, Twitter, for me anyway, it's perfect because it's brief, right? It's little blurbs that people are putting out there. It's a community of people talking about things they're interested in. And so this conglomeration of folks is gathered around energy. And so, hashtag EFT is what everybody uses. That's the energy FinTwit community. And it's like any other community, you get out of it what you put into it. I think you can learn a lot by just watching. You learn more by interacting and ask people questions and why and whatnot. And so what I've found is, for me, I get a lot of information from public sources. And there's a lot of folks on here that are very practical, in the weeds. And that's really good data for a guy like me that operates up here on public company information. And so it's not non-public information, it's just information at the field level, which is really helpful. And it's smart guys with good insights. And I worry it was skeptical about shale early and correctly, because guys at the field level were seeing what was happening and saying, this is not translating to what I'm seeing at the public company disclosure level. But I worry that having seen all this negative stuff, it's going to be too negative as things get better. There'll be a cyclical recovery, and some of that same bad stuff will be happening at the field level. It's just not going to matter as much for stocks. And I fear that the community will be too negative for too long. But I find it to be good sources of information, and I learn a lot from it. And so that's why I'm involved. And it can be fun. And so you asked about this video challenge that we did. You get random things in your feed, and one of the ones that kind of went viral was this guy who was riding on a skateboard, drinking Ocean Spray, listening to Fleetwood Mac. And the reason it went viral was probably the reason I liked it, because it just struck me as something pretty cool. This dude just cruising along and having fun. So we decided we'd have fun with it too. So we shot a video, kind of a parody of that video, and basically challenged the rest of the folks on Twitter that if they'd shoot a video, we'd pick out the best ones and give them some Pickering Energy Partners gear. And so we had about 18 people submit videos, everything from some silly ones to some pretty thoughtful and interesting ones. And we compiled them all and put the trailer out there as well. But it was a lot of fun, and it highlights that people are creative, and they probably spent way too much of their work time messing around with these things, but people are pretty creative, and it was really interesting.
Yeah, no, I thought it was great. And I agree. I think it's a very interesting community. The one thing, and it's not even a criticism, it's an observation. And I've been thinking about this a lot. 2020 has been a really weird year. And I think a lot of people's plans, they went into February and they were feeling generally content with their life, regardless of what your life was. And then this has sort of really thrown people at odds. I'm at odds with my parents. We have very different views on both coronavirus, but also the role of personal responsibility and personal accountability, and the role of government. And so we've all been taught, don't talk politics, don't talk religion, don't talk money. But then coronavirus sort of threw everything in. And the observation I had was, if it wasn't for social media, none of us would have been as afraid of coronavirus as we were. But it also, if it wasn't for social media, all of us would have been really pissed about being locked in our house, because we can have this virtual life, living with people we've never met and converse and chat and have this big online community that allowed us to stay in our homes without protesting. But the mechanism of communication is sometimes it's anonymous, but it's only 280 characters. Apparently, I typed something last night I didn't even know about. I mean, it was a throwaway comment as sort of like I've become so libertarian through this that I'm like, everything is about personal accountability. And a lot of the debate this year has been, well, is it equal outcomes or is it equal opportunity? But then there isn't personal responsibility necessarily for doing things. But anyway, we live in this world where 200 characters can trigger people. Like Trump would send a tweet and hundreds of thousands of people would lose their minds. And so I'm just curious if you think that social media morphs coming out of this year and people see the power of this tool for good or for bad. And to your point, EFT's been negative, but does it switch early enough, or do you double down on the hatred and then it divides the community as oil stocks rally? What do you think social media played in this whole crisis, and how does it morph for the good of society coming?
Yeah. I think more people on it because they're home and have more time and more access. I think that I think people are tired. They're getting worn out. I sense that depending on an individual's experience, they can say, this is not for me. I've spent 30 years having a debate with my clients, with companies. My skin's pretty thick. The other side of every buy trade is somebody that disagrees with me. They're selling me a stock. So they fundamentally think I'm wrong. That's okay. You take information from all of those interactions. So what I would say is anonymous makes people more outspoken and probably meaner generally than they would be in person. The trade-off is they're outspoken. You get more information and it comes in less friendly ways sometimes. I think that we'll probably see more people on Twitter and less people using it as we come out of this and the world goes back to normal. And has it changed the world? I don't know if it's changed. It's an enabler, and people are trying to figure out how to use that enabler. And what I'd say is I think I'm in the middle of my week of thanks on Twitter, where my tweets are only positive. I think people need to speak out. They need to be respectful. And if you do that, the likelihood of maximizing the outcome of using social media is probably higher. So that's a lot of babbling, but I think it's useful. You got to use it the right way. And I think we're all ready for things to be closer to where they were, back to normal.
Well, I like that, Dan. You're a very thoughtful guy. I'm very happy for you personally that the market has taken a turn for the constructive and the positive, because it's a lot easier to be in a bull market being able to provide context than the beat down that we've had most of the year. And I also love your approach towards Thanksgiving. It is the week of thanks, where we can be thankful for all of the blessings that we have. And I am blessed that you joined me today. So thank you very much.
Thanks a lot. I appreciate it, Dave. Take care.
All right. Until next time, be safe, be good, have a great day. Bye for now.